Good morning. Let's dive into how we can figure out the minimum daily profit for your Nasdaq Crypto Index and Dow Jones options using a bear call spread strategy during a bearish market. To calculate the minimum daily profit, we first need to understand the mechanics of a bear call spread and then consider how time decay affects the options values. Understanding the bear call spread, a bear call spread is a bearish option strategy that involves two call options with the same expiration date but different strike prices. 1. Short call. Sell to open. You sell a call option at a lower strike price. This generates an initial credit for your account. 2. Long call. Buy to open. You buy a call option at a higher strike price. This acts as a hedge, limiting your potential losses. You profit from this strategy if the price of the underlying asset, in this case, the Nasdaq Crypto Index or the Dow Jones, stays below the lower strike price at expiration. The maximum profit is the net credit received when you initiated the spread, minus any commissions. The maximum loss is the difference between the two strike prices, minus the net credit received, plus any commissions. Profit in a bearish market. In a bearish market, the price of the underlying asset is expected to decline. For a bear call spread to be profitable, the price needs to remain at or below the lower strike price by the expiration date. Ideally, it would move even lower. Calculating the minimum daily profit, conceptual. Calculating a precise minimum daily profit is challenging because time decay, theta. Options lose value as they get closer to their expiration date. This time, decay works in your favor when you sell options, as in the short call, and against you when you buy options, as in the long call. The rate of time decay accelerates as expiration approaches. Volatility, vega. Changes in market volatility can impact option prices. Lower volatility generally benefits short options positions and hurts long options positions. Price fluctuations. Even in a bearish trend, there will be daily price fluctuations in the underlying index. However, we can think about the potential for profit over time. Here's a conceptual approach. 1. Determine the maximum potential profit. O. Calculate the net credit received when you establish the spread. O. Net credit equals premium received from short call, premium paid for long call. O. This net credit, minus commissions, is your maximum potential profit if the underlying price is at or below the lower strike price at expiration. 2. Estimate the time to expiration. Determine the number of days until the options expire. 3. Consider time decay. O. The short call will lose value due to time decay, contributing positively to your profit as time passes, assuming the underlying price stays below the strike. O. The long call will also lose value due to time decay, which will erode some of the profit from the short call. O. The net effect of time decay, theta, on the spread will depend on the specific characteristics of the options, strike prices, time to expiration, implied volatility. Generally, a short-dated bear call spread will experience accelerating time decay as it approaches expiration. 4. Factor in price movement, bearish scenario. If the market moves further down as you anticipated, the value of both call options will likely decrease, increasing the profitability of your short call more than it decreases the value of your long call. It's important to understand that there isn't a fixed minimum daily profit. The profit accrues over time as the options approach expiration and as the underlying price behaves as you expect. How to get profit from a bear call spread in a bearish market. The profit from a bear call spread in a bearish market comes from several factors. Price staying below the lower strike. If the price of the Nasdaq Crypto Index or the Dow Jones stays below the strike price of the call option you sold by the expiration date, that short call will expire worthless. Decline in option values. As the underlying price drops or stays stagnant, the value of both the short call and the long call will likely decrease. However, the short call's value will decrease more significantly relative to its initial premium received, contributing to your profit. The long call's decrease in value limits your potential loss. Time decay. As mentioned earlier, time decay works in your favor on the short call, eroding its value as expiration nears. While it also erodes the value of the long call, the net effect, if the bearish scenario plays out, should be positive. Managing the trade. Monitor the underlying price. Keep a close eye on the Nasdaq Crypto Index and Dow Jones. If the price starts to rise significantly and approaches your short call's strike price, you might need to take action to limit potential losses, e.g., closing the spread. Consider early closure. You don't have to wait until expiration. If you've achieved a satisfactory profit before expiration, you can close out both legs of the spread, buy back the short call, and sell the long call. Understand the risks. Be aware of the maximum potential loss if the market moves against your bearish outlook and the price rises above your higher strike price. In summary, the minimum daily profit isn't a fixed number, but rather a potential accumulation of profit over time due to price action and time decay, assuming your bearish outlook is correct. The maximum profit is capped at the initial net credit received. To get a more concrete idea of potential profit, you would need to 1. Specify the exact strike prices and expiration dates of the call options you've used. 2. Know the premiums you paid and received for each option. 3. Use options pricing models, like Black-Scholes, to estimate the daily time decay, theta, under different scenarios. However, this is an estimation and not a guaranteed daily profit. Let me know if you have the specific details of your bear call spread, strike prices, premiums, expiration date, and we can discuss the potential profit and loss scenarios in more detail. Please like, subscribe, share, and comment.